Good afternoon, everybody. This is Chrissy from Solstice ATR and Vulcan Capital Research. I hope everybody's doing great. On this Saturday, this video will be for the coming week, for September 20th till Friday of next week. I will be going over certain sectors in the industry. Is this a normal stock market correction or early stage of another recovery or a plunge? The reason why I said is this, because we have been in balance for the last 2 weeks. As we can see on the combination of those four instruments, the S&P, the Nasdaq, the Russell, and the Dow Jones Industrial Average. I will zoom in and let's just look at them. Last week's candle was basically an inside candle of this week's. We're basically inside the range of last 2 week range, so 9-day balance. If Sunday we either gap up, gap down, or go sideways. Let's first of all break down each instrument one by one in order to understand where we are at. So I'm going to go for the hourly chart, 20-day, 78-minute. And the reason behind this, I always measure the distance either from the low to the high or from the high to the low in order to recognize where the 61.8% is and the 38% range is in relationship to the expansion to the upside on extension or the expansion to the downside on the extensions. So as you can see, the last week range, this is, Friday all the way till Friday, Thursday, Wednesday, Tuesday, and this was last week's Friday. We've been inside the range of those four instruments, and this week we looked above the prior weekly range from the prior week, and we looked a little bit below the prior week's low, but we closed inside the range. Remember, we can either gap down, gap up, or stay in range until we resolve out of the compression in a direction or the move. And at the same time, in the last couple of days, the last 2 days, we came out of the compression, out of the squeeze to the downside. This usually counts how many candles out to the downside or upside after the 9-dot rule compression. We've got 1, 2, 3, 4, 5, 6, 7, 8, 9, and we finished inside the prior week's range. So make sure that you understand we're going to trade what we see in front of us, not what we think, and this is the most important thing. Let's break it down one by one by looking at it a little bit more in detail, and I will use the 4-hour to keep an eye on the technicals. If we go to ES, which is the S&P 500, and I'm going to zoom in on the last 2 weeks since we had that prior high. We consolidated for a week. We came back, looked up, came back down, and couldn't clear the range of last week's consolidation from Sunday. Are we a little bit weaker in range? Yes, we looked below but came back inside the range, but we were not able to take the prior Monday night high because the Tuesday high or the Wednesday from last week, we did not clear that 30, 24, 25 area. We looked into the 19 area, 33, 94, 50, and the overnight was 34, 18 quarter, 34, 18 quarter, 34, 1950. We're not able to take the 24 or the 24 quarter from prior last week's range and the Monday overnight range from the Sunday night where we fell down, continued. We're still in range until we come out of this compression. And here's the reasons why I want you to look at it. We're going to look at this range here in the last 5 days. And I want you to keep, if we do gap up on Monday, keep an eye on the 61, which would be the 38% inversely. If we're going up, that would be the 50, and that would be the 61. I drew this backwards to show you where the 38 would be and the 61 would be if we cannot come back from the prior move down from the 38, 50, 61, cannot clear it we keep continuing lower, and we'll get the extensions to the downside or the upside. This would be the 123. We'll have the 138 and the 50 lower. So trade what you see. That's the S&P 500. Let's take a look at the Dow Jones Industrial Average, YM. YM is in a similar situation, in the same range of the prior week, but we looked above on Wednesday above the prior week, Tuesday overnight range, but not the Wednesday. We basically cleared that range. This was only done in the overnight. So we're going to trade what we see, but we never lost the prior week slow. We stayed in range because we're going towards a little bit more defensive stocks in the Dow. Let's take a look at the RTY/RTY. That's the small cap. Small cap consists of the banking sector, and you can always keep at the banks. You can always keep an eye on the BANK, or like Citibank, Bank of America, Wells Fargo, JP Morgan, or BlackRock, or Goldman. You can get a better idea what the brokerage are doing, as well as the insurance companies, to keep us intact in the Russell, because part of the Russell has about 26 to 28% holding in the banking sector. And at the same time, our dollar, American dollar, compared to gold, the fear gauge, or the VIX, or compared to the Aussie dollar, Japanese dollar, the European dollar, the British pound, the Canadian dollar, the Swiss dollar, it will keep us intact if there's global currency wars in the oil sector, banking sector, as well as the small cap. As we can see, the small cap in the prior week range, we stayed a little higher in small cap compared to the Dow and the S&P, where we were at the lower distribution, and we are inside the prior week range on the upper side from last week Sunday and Monday overnight. We looked up on Wednesday, came back down, but we stayed in range on small cap to close just a little here under Thursday's range from last week, small cap. Let's take a look at the Nasdaq, and we can look at it a little bit more in detail. The Nasdaq is the one that's a little bit weak in the sector because they're rotating from Nasdaq 100 to defensive value play, transportation, industrial, homes, to agriculture and consumer products. Remember, there always will be sector rotations throughout the year, and if they do find a cure for the COVID-19 and everything goes back to normal and reopening and the elections around the corner, things will change to be more bullish than bearish, or bearish than bullish. I know who I would vote for, but I don't want to get into it. There's a lot of reasons going on here that I want people to keep an eye on the Nasdaq 100. Let's just zoom in here. As you can see, the prior week was a little higher. We retested the 200 SMA. Couldn't do anything on Wednesday. We fell back down below the last week's range to come back and close above. This was 10.924, and we closed right at 10.26 or 27 in that area. That candle, this is after hours. The candle was 24, and the after hours was basically at the 38.50. So remember, we're going to trade what we see. Always keep an eye on the 61.8 or the 38%, or vice versa, the 61 or 38. If we're going to go up, this becomes 38, and this would become 61 for resistance. And if we break up, we continue higher. And if we cannot take that, we look for the extensions to the downside. So this is the Nasdaq. And let's take a look at the GC. And GC here, as you can see, in the last 10 to 12 days have been range bound. Last week's Thursday, Tuesday, Monday were in the lower distribution. We looked up on Wednesday, Thursday, came back inside the last week's range. We looked up a little bit, but we're still in consolidation. In order for gold to continue higher, we have to keep an eye on the American dollar to keep us intact to either to the upside or downside. If there's no fear, gold will come back in, market will rally. If there's fear in the market, then and the bears do try to take over the sectors, then gold will have potentially to going higher. So that's gold. And let's just zoom in once so you can see it a little bit more. The net compression, you can see where the range is in the last week from low to high, 5 days range. Let's take a look at oil, CL. Okay, let's zoom in to the right. I don't know what happened here. Grab it. Okay. As you can see, oil in the last week was consolidating in the lower distribution. We came back, retested the extension. If we took last week's range, we touched the 161 extension to the top. We came back in on Friday in the upper distribution. For oil to continue higher, we must sustain the 38.2 fib, which is the $39.80, or the 39.27 in order to continue higher. If we lose this area, we fall down. If we're going to continue higher, we look for the extensions to the upside, and these are the 23, the 38, and 61. And this is going to be a very important area to get back to the 43.58. If things do go south, you look for the 61, then the zero line. If we continue higher, you look for the zero line, 23, 38, 50, then the 61 in the upper distribution of the last 4 weeks range. So I hope this was helpful in oil. Let's now go to BTC. I did not set up anything in BTC. I got to fix the fib, and this is why I left it alone from the prior week. As you can see, it rallied back in the last 2 weeks, consolidated, pushed higher, but it's still sitting under the extension of the 161. This is very important. We look at the range in the coming week. We're going to remove this drawing, and we're going to take the last 5 days range. This is the high. And where is the low from last week? This would be Sunday right here. And what we do, we measure the distance. If the 61 gonna hold, if I measure it from top to bottom, that would be inversely. If I'm gonna be bullish, I gotta draw it the other way around. So what I would do, I'll take the bottom from here. I'll measure this to the this week's high, and my 38 should act as support for BTC to continue higher. If BTC wants to continue lower, it's going to lose the 38, the 50, 116 SMA, the 200, and eventually, which is the 61.8 fib, the 200 SMA 78, come back in the last week's range and come back to the 123. In order for BTC to continue higher, has to clear the zero line to get to the 23, then the 38, 50, then 61. So we're going to trade what we see in the instruments. Don't be biased to one side and get caught. So that's BTC. Let's look at the dollar, and I'll go in a couple of equities, and we'll finish up that way. DXY. I'm not going to go through all the currencies. Oops, dollar sign, DXY. And I did not do the fibs on the dollar. This has been in the last 2 weeks range, and I kind of kept it here from the prior week. Have you noticed this week we retested the high almost? We fell down to the prior last week's range, but we are inside last week's range. I can keep this fib more or less because it's in range, or I can go for last week's range, which is this area here, to this area here, and draw the fib for the weekly range from Sunday through the high of this week. So we grab this area here, and I grab this area here. Okay, this is the range. And if the DX gonna extend itself, edit properties, I'm gonna extend it to Sunday. So that's the 16, that's the 15. We're gonna go 1, 2. That will give us the range for the coming week, and this is no longer valid because it's a 2-week range. More or less, it's similar. I can remove it. So we took the the weekly high and the weekly low to see if we're going to clear the 38, the 50, 61, eventually come back to the 100% to continue higher. If we cannot clear the 38.2 fib, we'll look for the extensions to the downside. So let's do a couple of ETFs. And what I want you to do in the ETFs, I have a little PowerPoint. We will use that and you can do the homework yourself on it. I will just cover AAPL. Apple, as you can see, I have the 5-day range. In order for Apple to continue, has to clear the 38.61 to continue higher, or if falls to zero and we get a gap down, look for the extensions to the downside. That's Apple. Let's take a look at Amazon. As you can see, Amazon has lost its prior weekly range. It fell a little bit down but came back in. In order for Amazon to continue higher, has to clear the 38.61, get back in the prior week's range, which is the 31.15, let's call it 31.15, in order to continue higher. Let's take a look at Facebook. Facebook in a similar situation, it lost a little bit, because remember, I'm showing you the Nasdaq sector. Let's take a look at Google. Oops, that's the ABC pattern. Similar situation in order to clear. Let's take a look at NFLX. Netflix already anchored. You can see it. In order to clear, it has to clear the 486 area. Tesla did a great job. You know, it consolidated for a week, looked up, came back in, but it's in the upper distribution of last week's range. In order to continue higher, has to clear this high. If if Tesla does lose the 38.61%, the 50 and 38, which would be the inverse relationship, then it'll fall down. If it continues higher, look for the upside. I'm not a fan of Tesla. I'm not going to go there. Let's do one more, and I'll do AMD, because a lot of people keep asking me, because AMD is similar to the S&P. It follows that in ROKU. That's similar thing, similar situation. It's in the lower distribution. In order for AMD to get back higher, it has to clear 79. Let's take a look at ROKU. Similar situation here, but it is a little bit more stronger coming back up. So keep an eye on ROKU. If it clears the 61% fib, which is the coming down, it cleared the 38, it's sitting on the 50 in order to continue to get the extensions to the upside. Let's take a look at TLT, which is the ETF for the bond market 20-year. You can see there's been consolidation in the last 2 weeks. Let's take a look at the VIX. That's the VIX Fear Gauge ETF. As you can see, it has fallen down, but it's going in the last week or so in the same consolidation, had a little bit weakness in it below the prior week's range. Let's take a look at I believe it's RSP. This is the S&P Invesco S&P equal weighted ETFs for the S&P 500. As you can see, it is in the prior last week's range, in the middle of it. It looked up, came back in. If you look at the SPY ETF for spiders, this is the S&P 500. Similar situation, but it is a little bit rare below, enclosed inside the above the 29.95 quarter. As you can see, we looked up, came back in a little bit, but it's inside the lower distribution. If you look at the IWM, this is the small cap. As you can see, it's in the upper distribution instead of being in the lower distribution. And if you look at QQQ, the ETF of the Nasdaq 100, it's in the lower distributions of last week's range, in the lower distribution. And there's one more I want to show you. It's XLP, which is the 10-year conservative sector trust for staples. You can see that the distribution is a little bit below that sector. And there's one more, which is XLK. which is the 10-year notes XLK. Because I'm always looking at different ETFs, and people ask me why you don't trade all ETFs. I'm a future trader slash equity trader. I look for direction in those instruments. These will help you. If you cannot trade the futures in your retirement account, you can trade the ETFs. And this is showing you the Trust for Technology ETF in the lower distribution in the last 2 weeks. So let's go to the PowerPoint before I close. As you can see, keep an open mind, better than expected outcome. It can be bullish conviction or bearish conviction as of Friday, September 20th close. This is the daily range. I put some of those instruments there, comparing the TLT to the SPY or comparing the retail play value to the TLT or the QQQ to the TLT in relationship to the weekly range rate of return. If there's fear, VIX should have been up, gold should have been up, and our dollar should have been in the other direction compared to the Aussie dollar, Japanese dollar, the Canadian, the British pound, the Swiss franc, and the Japanese. Unfortunately, it's vice versa, and gold compared to the QQQ was a little bit more on the little slash weakness. So trade what you see, not what you think. Let's go back to the next one. Where is it? Oh, I didn't pick. Oh, okay. I just have this one. Okay. I didn't pick all of them. Let me just go get them for you from my list. Where is it? Where is it? Uh-oh. Okay, I had something. Looks like I lost it. Okay, I'm going to go to my desktop. I'll get them from there. No biggie. I will get the September 20th. Oops. This is the one I was showing you. Oops, come on. There it is. That's the S&P gaps of last week, August 3rd. I had showed the QQQ, the Nasdaq in relationship in our group, and the tech sector, the VGT, which is the ETF for the tech sector, as well as the S&P 500. You remember, I use these for education purposes. I do not say we are a broker dealer or past performance can be future results. These are for illustration use only. Use at your own risk, and the data that I use, please try not to copy it. Okay, here, asset class performance in 6 cases since the 1984. This is from LPL Research, LPL brokerage firm. This is the disclosure from 1969 all the way to 2018, showing us what the bond has done in the last 6 weeks to 2 months, compared in relationship to 4 weeks out, as well as 2 years out, the S&P 500 and the Nasdaq 100. As you can see, the performance of the S&P and the Nasdaq over time on the short time looks ugly, and on the long time looks good if you are an investor. Remember, there's a difference between a day trader and an investor. Trade what you see, not what you think. And I hope this was helpful. And I will close with this on the SPY/ES. Remember, if I'm going to show you this on the daily, remember, I do have those fibs, but I want you to understand on the daily, we are still in this up channel. We do have this gap here. We have gap 1, gap 2. Let's just zoom in from here. Okay, as you can see, we got gap 1 from March 23rd. Then we got another gap here on 4/6. Then we got another gap here on 5/18. Then we do have one more gap here, which is from I believe 8/3. This one we already retested, and as we can see, we are in a linear regression channel. In an up move, we are on the 50 simple moving average and a linear regression channel. We do have the 200 and the 116 sitting underneath us. We do have the extensions. We have the 18 simple moving above us. So So when we're gonna trade what we see, not what we think. You can see that at 50, we're right underneath it. In order for this to continue lower, we have to break last week's low in order to continue. We may gap 50 points lower, we may gap up 50 points higher. So remember, don't be biased to one side. If the market was going to be bearish, it would have lost it over the week. On Friday and Thursday, the bears would have got their hands on it and grasped it very well and took it lower. But unfortunately, the last 2 days they tried, they won. I'm not saying they didn't, but the bulls came back and brought it back inside the week before range. So don't be biased. Trade what you see. Most of it is psychological. I look forward to seeing you at solsticeatr.com, or you can check me out at Chrissy Farah on Twitter, my handle, and that would be great. Look forward to seeing you or on Discord. Over.